Hello and welcome everybody. Welcome to this weekly market recap for the week ending Friday, June 27th, 2025. I'm Tom Boley, Chief Market Strategist here at EarningsBeats.com. It's a pleasure to be with all of you. We got one more day to close out the second quarter. And you remember how we opened the second quarter back at the beginning of April? It was with about a 10% drop in the first week and a move down into bear market territory. And I said back then, continued to say throughout the quarter, that we were heading back to all-time highs, and we close out the second quarter with an all-time high on Friday. Now, we don't know if we're going to close there on Monday, but we did come all the way back up. We did manage to get back to all-time highs. So I thought that was a real positive. I think that proved our theory correct at EarningsBeats, that we were in just a cyclical bear market, that we were going to return back to all-time highs, and now we've done it. So I think that was a good thing. Inflation, even though the Fed continues to be on inflation watch, we are not. I see money rotating big time towards a lot of the aggressive growth areas of the market. That certainly does not feel like inflation's a problem. Also, if you're following the 10-year Treasury yield, you note that the 10-year Treasury yield's been dropping quite a bit. Once again, you would think if inflation was a problem going forward, investors would require a higher return on that 10-year Treasury yield. So I think the fact that money is still rotating into bonds, sending yields lower, and money is also rotating into aggressive areas of the market, I mean, that is the anti-inflation trade. So you tell me, you worried about inflation? Because I'm not. Until the market changes, until I see different rotation, the rest of it's just noise. So as far as I'm concerned, what the Fed's coming up with, what the media is coming up with, they can continue to talk about it all they want. But the big money on Wall Street is not paying any attention, and neither am I. So let's continue to focus on what's important and what's been working in the market, which is growth, which is being on the bullish side. We'll let the rest, fall out where it may. This upcoming week, we do have a couple things to keep in mind. We got a jobs report coming up on Thursday. Normally it's out on Friday, but we do have a holiday shortened week this week, as Friday will be July 4th, or actually July 3rd, but it'll be celebrating July 4th. So I think it's actually, no, I think Friday is the 4th. I take that back. So I think Friday is the 4th. So the market will be closed in honor of the July 4th Independence Day. And so the market's got only 4 days of trading this week. So that Friday non-farm payrolls report will be reflected and announced on Thursday morning. So that's one big thing that we have to certainly keep an eye on. Crude oil prices have been falling through the floor over the course of the past week or so. There was a lot of tension in the Middle East. It seemed to be escalating last weekend, but came quickly to a halt. We saw a lot of that panicked oil trade completely fall apart. And instead of crude oil prices continuing to move up, we saw crude oil prices actually dropping considerably last week, which certainly impacted some of the energy areas of the market, which did not perform nearly as well as most other areas of the market. Also, one other thing I think is going to be on a lot of traders' minds is going to be the tariffs. We do have those the deadlines that President Trump had set. We've got that coming up into focus. Whether or not they get extended, whether or not we have trade deals, who knows? But that's certainly going to be something that's going to be talked about this week. But yeah, other than that, I mean, we're in a market back at all-time highs. We're at a market with the volatility index, instead of being at 55 or 60, it's back down to 16. Continues to fall. Seems like just about every day. And so I think we're getting more back into a normal type of secular bull market rally. One thing that I've noticed quite a bit recently is that we're getting a lot of gap ups. Remember back in April and in March, when we had all the tariff news dominating the headlines and the possibility of stagflation and inflation and the Fed turning more hawkish, all of that leading to a lot of gap downs and then eventually intraday recoveries. Well, now we're kind of going the opposite way. We're actually seeing gap ups. Once Wall Street's filled all their coffers, they got all their, all the stocks that they wanted, went through a period of manipulation where we saw a lot of those gap downs that were scaring a lot of retail traders out of positions. And then we had Wall Street throughout trading days seemingly buying with both hands wide open, taking any shares that folks wanted to unload. And now we see why. Anyhow, I'll talk a little bit more about that manipulation because we had a big session on Saturday, which if you didn't see it, you probably should. But I'll point that out to you in just a bit. But let's go ahead and take a look at what happened last week and get this party started. So last week, you can see transportation led, gaining almost 5%. There's a lot of positive that we can take away from transports leading like that during a week in which we break to an all-time high. I'm going to talk about that a lot on Monday evening when we take a look at our third quarter update, taking a look ahead at the third quarter, seeing where things stand, where we think things are going. We do that for our annual members each quarter. And again, I'll talk about that a little bit more later in the show. But right now, transports starting to show a lot of strength. And you can see that the number for last week. NASDAQ gaining over 4%. Dow Jones, S&P both over 3%. Russell 2000 gained exactly 3%. And our S&P 400 mid-cap index gained a little bit more than 2.5%. But those are solid gains across the board. Not everything is trading at an all-time high, but we did get the S&P 500, our benchmark, up there to trade at an all-time high. I think that's a really, really bullish development for U.S. equities. All right, moving on to the sectors. You can see down here on the bottom, this is what I was referring to in terms of energy. Energy sector, the XLE dropped over 3.33% last week. The only other group that was down for the week was real estate. Consumer staples coming in just about flat. But if you look at the top of the leaderboard, I mean, it's all aggressive areas. We're breaking out to all-time highs, and it's being led by aggressive areas. That was not the case back in February. We had lost a lot of relative strength in technology and consumer discretionary and some of these other aggressive areas at the time of those highs in February. And that was one of the reasons why it looked to me like the market was in trouble. I was looking for a correction. We actually had a correction at the end of March. And then in one quick, swift move to the downside, beginning of April, we quickly turned a 10% correction into a 20% cyclical bear market. And then we started to rally. But leading that advance back in the February period when we hit that all-time high it wasn't these five groups. It was more the defensive areas that were starting to show strength in that final stage of strength, which is never, never a good thing for the market. And we talked about that, talked about being in cash, talked about how the risks were increasing about being long back then. And I said the same thing. I flipped it over and literally, I think it was on April 9th or somewhere around there, I sent out an email to our members at EarningsBeats and I said, I'm all in. That the risk is too great to not be in the market because we had already fallen back that 20%. So the odds were stacked much more against the bears than they were against the bulls at that point in time. And that was all proven correct, as we've seen here over the last few months. But yeah, look at the aggressive groups leading. Communication services jumping 5%, technology almost 4.5%, discretionary almost 4%. Look at the difference between discretionary and staples. Massive, massive outperformance by discretionary last week. This is the kind of behavior that sustains moves to the upside. I'm getting questions, a lot of folks saying, hey, we're back up at highs. It kind of looks like it did back in February. I'm thinking, are you looking at the same charts I'm looking at? Seriously, this is not the way it looked back in February. I can promise you. Go back and take a look. Discretionary was underperforming staples as we were putting in that final high. That ratio was going down. Now that ratio is going up along with all the other growth ratios, growth versus value ratios. Those, what I call my sustainability ratios, they are supporting further upside in the market. So be careful just because, maybe if you missed out on some of the move or maybe you're still sitting on the sidelines and you're wishing the market to go down, that's completely different than actually seeing signs that it's going to go down. I don't see those signs. I see the market wanting to continue to move higher. S&P 500. So here's your breakout. 61.44 was that close back on February 19th. Friday, finally, we closed 81.73. And it was interesting in the afternoon because we got up to 61.88. And then look at the action. I'm going to show you this 10-minute, 5-day chart. It looked like in the afternoon that we're going to fall apart. We're going to have a false breakout. And I was thinking, well, if we don't finish, if we finish like that or finish even weaker and finish in red territory, there's a chance that short term we top and maybe we go back to the 20-day moving average. That's what was going through my head at 3:00 on Friday. And then the buyers came in and absolutely took the indices right back up near their highs of the day, back into all-time high territory. And that close on Friday and the way that the aggressive groups performed last week tells me that this rally isn't done. NASDAQ 100, you can see also making the breakout. See the double top back in December and then again in February. We cleared that. Now we're just kind of tacking on. Gains are just tacking on. IWM, small caps, nice bottoming reverse head and shoulder pattern. Here's the neckline coming across. We broke out a couple of weeks ago out of that pattern, went back, tested the 20-day moving average. This candle right here looked like we were breaking down at the beginning of last week, and then we rallied strongly into the close on Monday, and we were able to tack on further gains in the small cap area into the end of the week. I expect that we're going to continue to move higher in the small caps. Watch that rising 20-day moving average to the downside. Possibly, if you're looking at price support, look down around 206, 207 on the IWM. 10-year Treasury yield. This is what I was just referring to. Look at the 10-year Treasury yield coming down. Folks, if you're worried about inflation, the last thing you want to do is buy bonds and send the yields lower. What you would be doing is getting out of bonds. Why would you want to hold a bond that yields 4.25% if you're worried about inflation? Makes no sense. If you think inflation is going to surge back up to 3, 4, 5%, do you want to hold a 10-year Treasury yield or a 10-year Treasury bond that's yielding 4.25%? I wouldn't. The market's not telling us that we have inflation. And that's what I've been saying all along. I don't have a crystal ball. I can't tell you what inflation is going to be in 4, 5, 6 months. I wish I could. All I can tell you is that I can read the story on the charts, and the money that is rotating in various areas of the market suggests inflation is not a problem. Zero problem. So you can listen to the Fed if you want. You can listen to the media. You can think for yourself. Market's going down. You can convince yourself whatever. In my opinion, I think it's being way biased. I think if you're objective, you look at the charts, I think it's telling you want to be in this market and inflation is not going to be a problem. Technology. I wanted to point out technology. You can see we were sideways for a while, December, January, February, trying to get through this 240, 242 area. Came up here and we hesitated throughout much of June. Last week, cleared it. I think the chart looks really good. XLY, not to the same extent as technology, because you can see we're still way off the highs that we had back in December of last year. And a lot of that, the XLY, 40% of the XLY, maybe a little bit more than that, are made up of Amazon and Tesla. And Tesla was much, much higher last year than it is right now. Tesla's weighed on the index. But what I do like about this chart, a couple things about this chart. First of all, discretionary was in a bull flag. You had a flagpole, and then you had this flag action. Friday, we had very, very strong action into the close in discretionary stocks, and we made this breakout. So I'm looking for more strength ahead here in the area of discretionary. Now, if we pull up a seasonality chart and we look at discretionary and we go back, say, the last 13 years, which is during this current secular bull market, look at July. We're literally, Monday is June 30th. We're going into July on Tuesday. July, XLY has been up 12 of the last 13 years. And it averages going up 4.2% per year during the month of July. That's an average. So we're just now breaking out to an all-time high, and we're just getting a breakout in the XLY. I could argue that we're probably going to do better than average based on where we are technically on the chart. The only month of the year where the XLY has done better throughout this secular bull market is in the month of November, where we've averaged almost 5% gains. If we take this back 20 years, you can see that July is actually averaged going up 3% per year over the last 20 years. That includes some bear market years. But look across the bottom line here. It's actually July has the highest average among all 12 calendar months. So we're into a seasonally strong period right now with the XLY, which I find to be, I think that kind of adds to the bullish bias that's out there right now. And if I pull up the XLK and look at this over the last 13 years, July, 12 of the last 13 years higher, averaging 4% gains, second only to November. And if we go back 20 years, again, looking at technology, July has the highest percentage chance of any of the calendar months going higher. And the average of 3.2% during the month of July is higher than any other month. So the two areas that make up the two sectors that make up more than 40% of the S&P 500, both sectors over the last 20 years, their best month has been July. Just saying, it's a tailwind. It's a historical tailwind. You've got technical breakouts, and you've got other areas or other signals that are corroborating that bullishness. Communication services, look at the tops here, kind of coming up. I don't know, you call it maybe a cup. I don't know what you want to call it, but basically resistance was at about 105 on the left side in mid-February, which is when we topped. We got up there a couple of weeks ago, did the same thing, pulled back. What did we do? Hit that 20-day moving average, boom, right off of it to new highs, finished on the highs on Friday. I mean, to me, this chart looks absolutely beautiful. I can't imagine it's going anywhere but up. I mean, or could we pull back? Of course. I'm not saying it's going to go up every day, every minute of every day. We could have pullbacks, but I'm not looking for anything significant to the downside at this point in time. Semiconductors. So talked about technology, and I've talked about semiconductors over and over and over again. This is one of the most influential, I would say it's the most influential industry group that's out there. When this group is moving, it's a great sign for our economy. And look what it's doing. Excuse me. It's had a huge move up. Made the breakout, finally made the breakout, taking out the highs from 2024 and again early in 2025. I know it was, I think it was June of 2024. I talked about semiconductors making that huge run and topping. I'm going to go back just a little bit further on this chart so we can look at what I was talking about. But I wrote an article, I think it was on June 23rd, 2024. It's right here on that reversing candle. And I said, semiconductors have made a massive run up in less than a year, and it's going to take some time to consolidate those gains. I said, don't expect that semiconductors are just going to take off from there. I thought it would be a long period of consolidation. That's exactly what we saw. It was a year going sideways, going down, coming back up, failing to break out, going back down. And finally, just this past week, breakout in one of the most influential areas of the market, if not the most influential area of the market. And might as well throw software in there, because software is another group. When these two groups are moving to the upside and they're leading on a relative basis, don't argue. Just hop on board, just ride that train. And so that's what I'm seeing at this point. For those of you that are maybe watching for the first time or have just recently started watching us here on YouTube at EarningsBeats.com, go over to our website, EarningsBeats.com. Check us out. We've got a 30-day no-cost trial. You can always sign up for 30 days and just check out our service. That does require a credit card, just to let you know. But you won't be charged, and we'll even remind you at the end of your trial, before you get charged, we'll remind you, hey, you're going to get charged. Not only, here's what you're going to get charged on a monthly basis. No, by the way, we'll have a great annual special for you if you choose to stay on board, so that we can try and help save you some money on our membership. And speaking about saving money, right now we have a flash sale going because we had a huge event yesterday on market manipulation. Anytime we have these kinds of events, normally we'll run a flash sale for 48 hours, 72 hours to give everybody an opportunity to join us at a much discounted rate. So try and get a steep discount. Try to bring your costs down as much as possible so you can jump on with EarningsBeats and get what I believe has been the best, absolute best market guidance anywhere for the past, well, certainly since the pandemic. I think we've nailed every single top and bottom in the market since the pandemic. And I think we're continuing to refine our signals. And I think we call the market better than anyone. I have not seen anybody who calls it better. And we've certainly got a number of members, a lot of members that would attest to that. Anyhow, if you want to check out this flash sale, go to our website, click on this link. And when you click on it, it'll come up. You can claim the offer. It's a 20% off sale. So normally our membership's $997 annually. You can save 20% right now, save $200. You still got a day and 2 hours to go, at least at the time of this recording. So make sure you check that out, because tomorrow night, Monday night, I'm going to be providing my Q3 update. So every year we have a MarketVision event. It's on the first Saturday of every year, where I give my predictions, talk about the upcoming year. This year, what we decided to do for our annual members was to provide quarterly updates of that. So if anything's changed, we had members write in, ask about, do you still feel about the same on your target as you did back? Well, this is where I'm going to tell you every 90 days. So end of March, end of June, and end of September, we're going to have 3 quarterly events that are tied back to that MarketVision event. And in connection with this one, because we do have a big event Monday night, and it's for annual members only, take advantage of this annual special, please. We run these to try and get as many folks in as possible at the lowest possible price. We appreciate everybody taking the time out to try and learn more about the market, to learn more about us at EarningsBeats. And that's a nice, significant reward that we try to offer as a result. All right. So if you go to YouTube, here is the video. So you can just type my name in, or EarningsBeats, and then just type in Trading the Truth, How Market Manipulation Creates Opportunity. It'll bring up this video. This was 2 hours and 40 minutes, folks. I gave up over 2.5 hours of my time on a Saturday to try and explain to everyone what happened this year and how you can better improve what you do in the stock market going forward. You have to learn this stuff. If you don't understand the things I talk about in this video, I'm just going to wish you the best of luck out there, because the market is going to absolutely just grab you by the nose and drag you around. It's what market makers do. They literally point us and lead us to where they want us to go. You can't think that way. You've got to be thinking outside the box, like we do at EarningsBeats. You got to call the tops before they happen. You need to see the bottoms while they're happening. And if you do that, obviously it's going to make a massive difference in your long-term financial goals and where you end up. So please check us out. Also, anytime you watch one of our videos, it helps us. Even if you don't want to become a member, if you like our stuff, you're learning about the market, you don't feel comfortable trading, I get it. Not everybody wants to be in the market. Not everybody wants to pay a service. One other way you can help us is simply just by liking our videos, subscribing to our channel. Costs you nothing. And that definitely helps us build our community at YouTube. So think about helping us in that way as well. We certainly would appreciate that. A couple stocks I'm going to go over and just give you an idea. We do a short squeeze chart list. We have chart lists that we provide to our members. And think of these chart lists. That's what they're called at Stock Charts. Stock Charts is the platform that we use. This is where I do all my technical analysis. Of course, I talk about charts throughout many of my shows, most of my shows, my articles that I write. It's always stock charts. I've had a membership there for a couple of decades now. I love the site and I love using the tools. And so that's what you see on my screen. Anyhow, Stock Charts has tools, and one of those tools are chart lists, which are kind of like a fancy word for a watch list. It's just putting together stocks and organizing your work. And that's what we do. We organize a lot of different things and provide it to our members. And so one of these watch lists is our short squeeze chart list, which I just updated today, by the way, because new information just came out on short percentage of float on all the stocks out there. And so what we do is we put a list together of that most heavily shorted stocks in terms of percentage of float that's short. So all the outstanding shares, the companies that have the highest percentages of those outstanding shares that are short are on this list. And I just want to give you an idea. Here's the stock, ARS Pharmaceuticals. This was on the list last week. And you can see as it's making these breakouts, this triple top breakout here, look at the stock moving up and look at the volume expanding. Now, this stock gained, I'm going to show you on a weekly chart, this stock gained 15.19% last week. Now, S&P was up 4%, right? So this obviously we did much better on this individual stock. Well, I can tell you that this ranked 11th on the short squeeze chart list. There were 10 stocks that did better than 15.19%. Let me just show you. I stripped out the names and the ticker symbols, but here are the percentages. 15.19% right here. This is the one that you're looking at with SPRY. That's the one I just showed you. There were 10 others on this list that ranged from gaining anywhere from 16% to 46% last week. When these stocks start seeing heavy volume and they start clearing key resistance levels, these stocks have a tendency to explode to the upside because all these folks that are shorting have to buy back. They have to cover. So in order to cover, they have to buy the shares and then return them to whoever they borrowed from. So it's kind of one of these forced buying situations from time to time, and you need to at least be aware of this. And some of you who are aggressive traders probably would love to trade a chart list like this from time to time. So anyhow, I just wanted to point out that stock I showed you, SPRY, gaining 15%. There were 10 stocks on this chart list that were better than that. So things like that, you're going to get at EarningsBeats. We have so much information that we share with our members. Let me go through some stocks that I thought at the end of last week or throughout last week really started to put in some pretty impressive breakouts and charts and volume and so forth. NVIDIA is one of the leaders in the semiconductor space. I talked about semiconductors, how important they are. When one of the leaders like NVIDIA makes a breakout to an all-time high, you need to be aware of it. NVIDIA just broke out to an all-time high. Let me give you some others, not necessarily in semiconductors, by the way. Rocket Lab, you can see, look at the sideways consolidation. I see a move up, I see a cup, I see a handle, and then the breakout. So this cup measures from about 32.5 down to about 15. So we're talking about a stock that now measures up to about 50 on this breakout. It's trading at 35, 38 right now. So RKLB, interesting. How about Disney? Disney couldn't get out of its own way for a long time. Well, that seems to be changing because we're getting a lot of real solid bullishness moving up above the 120, 117.5 to 120 resistance level that Disney had faced for a while. So I like that breakout there. Booking.com. First of all, travel group on fire right now. So being able to find individual stocks within that space, like Booking, just making a breakout, pretty solid volume last week. I think especially with discretionary doing well, I think this is a stock that could really have a good summer. So Booking, keep an eye on that one. COMScope, sideways consolidation, really struggled to get through about $7 last week. You could see the volume pick up, smaller dollar stock, so it's a little bit more aggressive. Some of you might like that. We're not registered investment advisors, by the way. I always like to throw that out there. I'm not recommending anything. I'm not advising anyone to buy any security. Just make that really clear. We're pointing out educational, charts, things I like, my opinion. You should still check with your own financial advisor before buying. Understand the risks you're taking if you buy any of these stocks, but that breakout right there is undeniable. ANET, Arista Networks. I like the fact that it just kind of took out this double top right here, closing over 100 on Thursday, pulled back a little bit on Friday. But when I looked at that on an hourly chart, I really liked this pullback to the rising 20-hour EMA. So I think we might have a pretty solid week ahead for Arista Networks. Let's keep going. Let's go back to Flex, FLEX. This is Flex Limited. Another one that kind of hesitated about a week and a half ago at about the $45 level and then took off last week, easily breaking out to new highs there. Broadcom, AVGO, making another breakout at the end of last week, taking out an earlier high in June. I like that one. DoorDash has been just strong, just strengthening. It topped back in February, and while the market struggled, you can see sideways consolidation here for quite a while. Again, last week we made a big breakout, and I just like the area that this stock is in. I think we're going to see a continuation here. AVAV, this is AeroVironment. 3 days last week with earnings coming out, big gap up, excellent volume to support this huge move to the upside. Some of these stocks are overbought. We might get a little bit of a pullback, but I'd be sitting back waiting for pullbacks and being ready to pounce. And then another small cap stock that I gave probably a year ago or close to a year ago when I thought small caps were going to take off. NEON, Neonode, was one that I had pointed out I thought had a really bright future. could see this stock maybe triple, quadruple. And then, of course, small caps pulled back, and you could see NEON just went sideways. Well, it seems to be renewing now because we had the big breakout in mid-June, finished on Friday at another new high. This is a stock I think that could have a lot of upside. So I just wanted to point it out. All right. Again, week ahead, we're going to be talking a little bit about the trade war, the trade talks, the tariffs, that sort of thing. Seems like things have calmed down in that area. So I'm not expecting any major upheavals or anything as a result, but just want to let you know there's going to be more talk about that. And of course, I think the biggest thing is going to be the jobs report. Last week, the final Q2 GDP or final Q1 GDP came out, and it was down. It was lowered to minus 0.5% from 0.2, minus 0.2%. So it seems like the weakness in the economy, I mean, it's real. Do we have a horrible economy on our hands? No, but we may find out 3 months from now that we were in a recession, a mild recession. That wouldn't surprise me. Where right now the market is looking ahead. It's looking ahead to lower interest rates, and it's looking ahead to higher earnings and a stronger economy. That is going to help to fuel the stock market, in my opinion. How much? Come in on Monday night and check it out. I'm going to lay out a lot of different areas of the market, where I see the market going here over the next 3 months and into the end of the year. I don't think you're going to want to miss that, especially given our track record at EarningsBeats over these last several years. We've been pretty much spot on. We were spot on again in this latest quarter with the return to all-time highs. And, got a few things I want to share on Monday night. So hopefully you're there. Again, please, hit that like button. Subscribe to our channel. That really helps us. And if you can, go over to EarningsBeats.com. Check out this flash sale. If you're at our homepage, EarningsBeats.com, both plural. Scroll down, 48-hour flash sale. Save yourself $200 and join me on Monday night. Love to have you. Have a great rest of your weekend. Enjoy the upcoming week and the holiday shortened week. Enjoy your 4th, and happy trading, everybody.